Hi guys, welcome to my channel. In May, you managing $100 million for the bank. You know you will need the money in 6 months and you don't want to gamble on stocks. You don't want to lock the money away for 20 years. But you also don't want the cash sitting completely indoor. So whether a professional investor put up money, this is where money market instruments come in. They are short-term debt security designed primarily for liquidity, safety, and short-term cash management. And among the most important instruments is one that looks deceptively simple, the Treasury bill. Today we understand what money market instruments are and why they are considered relatively low risk. Exactly how a Canadian Treasury bill generates a return even though it doesn't pay regular interest. Let's start with the big pictures. We already know that money market deals with short-term debt. Now we need to look at the actual securities traded in that market. These are called money market instruments. Think of them as short-term contracts between borrower and lenders. A borrower needs cash today. An investor had issued cash today. The borrower promised to repay the money relatively soon. Because the maturity is short, there is less time for economic conditions to change dramatically. That generally means less price volatility than we see with long-term securities, and that's an important point. Money market instruments are not necessarily attractive because they generate spectacular returns. They are attractive because they combine three things: liquidity, relative safety, and short-term income. Now let's look at one of the most important money market instruments, the Government of Canada Treasury Bill, often called T-bill. A Treasury bill is short-term debt issued by the Canadian federal government. The government receives money from investors today. In return, it promises to pay a specified amount at maturity. Treasury bills can issue with maturity set at 1 month, 3 months, 6 months, or 12 months. And here is the interesting part. A treasury bill doesn't normally make periodic interest payments. Instead, it is sold at a discount. That's the key concept. You pay less than the amount you will receive at maturity. Let's make this concrete. Suppose the treasury bill had a face value of $10,000. You don't pay $10,000 today. Instead, you pay 9,600. 1 year later, the government pays you the full 10,000. So what happened? You invest 9,600 and you receive 10K. Your dollar return is $400. There's one no money monthly coupon. There's one no quarterly interest payment. Your return came from buying the security below its face value and receive the full face value at maturity. Now, why are treasury bills considered so attractive in the money market? One major reason is liquidity. Liquidity means you can buy or sell an asset relatively easily without having to accept a large price concessions. Treasury bills are among the more actively traded money market instruments. There are many investors who want them. Banks hold them. Financial institutions hold them. Corporations can hold them. Or the investor use them for short-term cash management. Because there is significant trading activity, it is generally easier to convert treasury bills into cash. It makes them particularly useful when investors know they will need their money relatively soon. So the second major characteristic is safety. Treasury bills issued by the federal government are generally regarded as among the safest money market instruments. Why? Because the borrower is the federal government, the major risk we are discussing here is the foreign risk. Default means the borrower failed to meet its contractual obligations, either failing to make a required payment or failing to repay the principal. For the federal government, such as Canada, the perceived probability of default on its own short-term debt is extremely low. The government had the ability to raise revenue through taxations and has substantial fiscal and monetary resources. So investors generally view treasury bill as extremely high quality short-term asset. But remember the precise financial language. Low default risk does not mean zero risk. An investment can be extremely safe without being literally risk-free. So who actually buy treasury bill? Banks are major holders. That makes sense. Banks constantly manage liquidity. They receive deposits. They make loans. They process payments, and they need to make sure they have sufficient liquid assets available. Treasury bill can help with that liquidity management. Households also hold treasury bill, although typically in smaller amount. Corporations and other financial intermediary can also use them to manage its cash. So treasury bills aren't primarily a speculative investment. They are a cash management instruments. That's how professionals should think about them. So from an investor perspective, here the real questions: when will I need the money? If the answers is next month or in 6 months or within a year, then protecting the principal and maintaining liquidity may be more important than maximize long-term returns. That's where money market instruments become useful. Compare that with a retirement portfolio. If you don't need the money for 30 years, you may be willing to accept much greater price volatility in exchange for higher expected returns. That's a completely different investment problem. So don't ask is a treasury bill a good investment. Ask is a treasury bill appropriate for my time horizon and objective. That's how professional investor thinks.